Don't play red light, green light with your money. In this educational episode, I'm going to tell you why my clients were never happier than when I got their money out of the market, the stock market. This happened back in the early 1980s, and I'm going to compare it to playing red light, green light. Maybe you did that when you were a kid. So I'm Doug Andrew, and I've been a financial strategist and retirement planning specialist since 1974. I'm coming up on 5 decades, helping thousands of people optimize their assets, minimize taxes, empower what I call their authentic wealth. Most people have viewed me as a financial strategist, retirement planning specialist, because I'm helping them prepare for long-term goals, such as retirement, so they will not outlive their money, so that they don't have to worry about the negative impact of taxes, inflation, market volatility during their golden years. So I make them immune from those things, those dangers, by converting their savings to tax-free vehicles and linking their returns to the things that inflate. I don't like inflation any more than anybody, but it doesn't hurt me. It actually helps me. And we do that by outpacing inflation using indexing with universal life. We also eliminate the danger of market volatility, because when the market goes down, you don't lose. When the market goes up, you get to benefit, you get to participate. So let's go back. In 1974 until 1980, I ended up being responsible for over 3,000 clients in 13 Western states. And I was a big buy term, invest the difference proponent. And so I had all of these clients investing money into mutual funds. Now, it was like playing red light, green light. If you ever played that game as a kid, sometimes you take, 15, 20 steps forward, but sometimes you take, 10, 15 steps back. That is like the stock market. I used to describe the stock market as like a person with a yo-yo, hopefully walking up some stairs. And people say, what do you mean walking up some stairs? Well, you hope that over the years, the S&P, the Dow Jones, the Russell 2000 is going up. Now, in actuality, there are time periods like the Great Recession, 2000 to 2010, 2012. That person with a yo-yo, their money in the market, it was going up and down, but they were on a flat surface, meaning 12 years later, if they had $1 million in the year 2000, it was barely back to $1 million again 12 years later. That's what I mean by a person with a yo-yo. The money went down and then up and then down and then up, and it was barely back to break even. People who had indexed universal life, my clients doubled and tripled their money during that time period. They didn't lose a dime in 2001, 2002, 2003, or 2008. They may not have made very much, but they didn't lose. So they were never happier than when I got them out of the market, because they would have lost 40% twice in that decade. So E.F. Hutton is the brainchild that came out with Universal Life in 1980. This is where you're using life insurance for living benefits. And so you're taking the least amount of insurance the IRS will let you get away with, and you're putting in the most money or premium that the IRS allows, and it turns into a tax-free cash cow. You are self-insuring in as little as 12 to hopefully no longer than 20 years, which means your cash value in the policy will equal or exceed the death benefit within 12 to 20 years. You're self-insured. The cost of the insurance now is next to nothing. And so have you ever seen an insurance policy get cheaper as you get older? Then you haven't seen one done right. So I had people back in 1980, they would put in $500,000, and many of them were already retired, and they started withdrawing $50,000 a year tax-free instantly without depleting principal. But then the IRS came in and convinced Congress to pass tax citations, TEFRA, DEFRA, and TAMRA. If you don't understand these, I have videos on this channel that explain those. But it means that you have to spread out the funding of one of these IUL policies if you want tax-free income later. you cannot put it all in at once. So if I had somebody that wanted to put in $500,000 after June 21st, 1988, if they did that, it would grow tax deferred. But if they wanted to start taking tax-free income, it would now be taxable. They did it for tax-free income. So they couldn't put in $500,000 all at once. They could put in maybe 20% a year, $100,000 a year, technically $100,000 the first day of the first year, and then another 100 the first day of the second year, the first day of the third year. And so in 4 years and 1 day into the fifth year, they could finally get their whole $500,000 in there. But the minimum death benefit was only for a 60-year-old, maybe about $1 million. When you get 500,000 in there, the net amount of risk is only now the remaining 500,000. They're only charging you for the net amount at risk. Many of those people, that 500,000 they had in their policy at that point doubled in 7.5 years because they were earning 9.6% returns. So now they have $1 million in there. The original death benefit was $1 million. So the net amount of risk is zero. And so the cost of the insurance now is basically Zippo. But if they die, TEFRA and DEFRA tax citations say that the insurance company has to pay out 5% higher than their cash. So if they died when they have $1 million in there, the death benefit's $1,050,000, $50,000 more than the original death benefit. But the insurance company is only charging you for the $50,000. The interest you're earning on the $1 million, golly, can be sometimes 10%, $100,000. Many of my clients have capped out at 25%, $250,000. The cost of $100,000 of insurance, even though you're older, is only $1,000 or $2,000. And so the cost of the insurance gets cheaper as you get older. And of course, $1 million, if you don't need the money, can double to $2 million in another 7.5 years. And so the point I was making at the beginning, back in 1980, when I was trying to earn for my clients average returns of 12%, and I was having to try to time the market and everything, that's really hard. But even if we could earn 12%, if they were going to realize a 12% rate of return average in the market, that's not what they're netting. See, if they earn 12, if they had $1 million and it was earning 12%, theoretically, they ought to be able to pull out $120,000 a year without depleting their $1 million nest egg. If they were really earning 12%, that's $120,000, but they pull that out of a tax-deferred IRA or 401k. Between federal and state income tax, they're in a 33% bracket, most of them. And so they have to pay $40,000 in tax on the $120,000. They're only netting $80,000 or 8%. They're only netting 8. So they're earning 12, but they're netting 8. Many of the brokerage firms, the asset managers, charge a 1% fee on that $1 million. That's another $10,000. So if you subtract taxes and fees, you have to earn 12 to net 7. You know what? That's why E.F. Hutton said, "What are we thinking? Let's not go put our money in a risky market trying to earn 12." Because Dalbar, who studies investor behavior, says the average person with money in the market, if they just buy and hold, which most don't do, you're going to average about 9.14. So you're earning 9 and only netting 6% after tax, only 5% after tax and fees. E.F. Hutton said, let's put our money in the multi-trillion-dollar insurance industry. They're the best money managers in the world. And we can earn, back in 1980, we can earn 11 and net 10. From 1980 to 1990, I never got credited less than 11.75%, as high as 15.5%. But I earned 11 and I netted 10, retroactive back to day one. So I can earn 11 more safely in an insurance company and net 10 after all the costs. In order to net 10 out of the market in an IRA or 401k, I would have to earn 15 or 16% after tax and fees to net 10. Does that make sense? So that's why my clients were never happier than when I got them out of the market. Now they can sleep. They can be calm when the market crashes because they don't lose. And when the market goes up, they get to benefit. When the market goes down, they don't lose, and they are able to earn a rate of return averaging with rebalancing 11%, 11.17 to be exact is what I've averaged since 1980, and a net return of 10.07. So they are so happy that they're not in that volatile stock market with that, the Wall Street casino, as some people put it. So if this is intriguing you and you want to understand how indexing works, I would recommend you study my 11th book. It's been flying off of our warehouse shelves. It's called The Laser Fund. And you can go to Amazon and get it for $20, but you're going to pay about another $10 in shipping and handling. If you do that, thank you. But I'll gift you a copy free. To claim your free copy, you simply go to laserfund.com, laserfund.com, or click on the link below. And you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, but I'll pay for the book. I'll fire out a hard copy to you via priority mail. When you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's audio and video formats. There's webinars we do on a regular basis. They're free. You can register for one of those. You can even schedule an appointment to talk to an IUL professional that I oversee that has had to pass a proficiency exam, so they can make some illustrations for you with no cost, no obligation, so you can see how a properly structured IUL can far outperform money in the volatile market, so you don't have to play red light, green light anymore.